Gupta, the chairman and MD at Havells, now joins in on the show to talk about how their numbers has been. Anil, good to have you on the show. B2C for you, at around 70% demand, continue to remain sluggish. Is the recovery anywhere in sight? And what's the outlook then for the full fiscal?
I think one of the reasons for the sluggish demand in the B2C has also been the unseasonal rains, which has affected the offtake in the months of March, April, and May. So I believe this might be a little bit temporary. So we may see some amount of pickup in the second quarter, but also third and fourth quarter, with the festival season coming around that time. I think we should be looking at a good consumer demand coming in as well.
Right. Mr. Gupta, can you tell us about the B2B demand? Because that's being driven by infrastructure, professional real estate, etc., and the construction segment. So what's demand like in the tier 2 and 3 cities?
Well, it's primarily being driven right now by the tier 1 and tier 2 cities. And so that's why there is some amount of slowdown in the consumer sector. But in the tier 1, tier 2 cities where the infrastructure and the government impetus on infrastructure projects is there, so that we are seeing good traction. Hopefully that should trickle down to tier 3, tier 4 cities in the coming time, but that's where the demand is coming from majorly right now.
And your EBITDA margins, they've seen a contraction in this quarter. What's the outlook for the margins, both in the long term as well as the outlook on ad spends?
I think we are quite optimistic about the fact that the contribution margin level, the gross margin levels are improving. And hence, once the operating leverage kicks in, when the volumes start coming back again, as I said, first quarter was hit by some unseasonal rains. We should be looking at expansion in EBITDA margins for the entire company.
And you've also planned a foray into EMS. What's the expectation from this segment?
I think, EMS is not something which we are looking for the Indian markets. We are looking at export markets, and we see an opportunity for products like air conditioners, for our switchgear, for cables. There is an opportunity for doing that. It is going to be more like a volume gainer for us to give operating leverage in our manufacturing units. And that, our exports is always a mix of our own brand and some private label manufacturing as well. And that will continue to be our strategy in the coming times. Given the fact that, we have good capacity now for air conditioners, that's also a possibility that we could be doing good volumes in the coming years.
Right. And Lloyd has seen some sequential improvement, but still overall negative at the EBIT level. What is the overall margin outlook, given that, there's still high cost inventory for Lloyd's?
I think high cost inventory is normalizing. We would have normalized by the end of the first quarter, but because of the lower sales in the first quarter, we should be taking a bit 1 quarter or more. But also the fact that, as I've explained, that we are investing heavily in Lloyd in terms of branding and distribution, also R&D and manufacturing. So it's a bit of a long-term play. Our focus there is market share gains and achieve a certain position of being amongst the top 2 or 3 brands in the country.
Okay, thank you so much for taking time out and giving us a sense as to how business is shaping up. That's a view coming in from Havells. Just a quick